You ever hear a sound that's too quiet? The kind of quiet that means something's about to break. That's the silver market right now. On the surface, still, calm. A dull metal drifting under the radar while everyone chases AI stocks, tech FOMO, and crypto flashpoints. But deep beneath, pressure is building. Numbers don't match narratives. Inventories don't match demand. And this week, that pressure might finally hit fracture point. Let's start with the uncomfortable truth. Silver is not the forgotten metal. It's the suppressed metal. Because for decades, its price hasn't just moved by supply and demand, it's moved by paper, contracts, futures, and synthetic trades so large they make the real metal look like a rounding error. Now, this isn't conspiracy talk. Look at the COMEX data. For every single ounce of physical silver, there are over 250 ounces in paper promises. Think about that. Imagine selling 250 houses you don't own and hoping no one asks for the keys. That's exactly how the modern silver market works. And this week, that illusion faces its first real stress test in years. Here's why. In early January, industrial buyers in Asia started pulling physical silver out of London vaults at the fastest pace since 2020. By mid-month, COMEX registered inventories dropped below 90 million ounces, down almost 70% from their peak in 2021. At the same time, US Treasury yields dipped, inflation whispers rose, and retail traders began sniffing out something strange in silver ETFs. Massive options positioning on both sides, building toward this week's expiry. Too many bets, not enough metal. Seems like a coincidence? Maybe. Or maybe it's a setup for what market veterans quietly call a black swan squeeze. A black swan isn't a crash you see coming. It's the one you can't explain until it's too late. And silver has all the ingredients. First, tight physical supply. Second, massive leveraged paper exposure. Third, rising macro instability. The dollar losing steam, central banks buying gold, industrial silver demand hitting records from solar panels and EVs. See the irony? The greener the planet tries to become, the more silver it quietly drains. Every gigawatt of solar power eats up kilograms of the poor man's gold. Yet miners are pulling out less year over year. You do the math. So let's pause for a second. If silver's so critical, why has it underperformed? Why didn't it soar when inflation spiked or when gold broke new highs? Here's the twist. Silver's not allowed to act free. The futures market sets the price, but only a fraction of those trades ever settle in real bars or coins. It's a system that rewards paper speculation over physical demand, until someone calls for delivery. And that might be this week's story. Because rumors are swirling that a few major industrial buyers, not retail investors, but corporations that need silver, are refusing paper settlement. They want the metal. Now. That alone could force shorts to cover, fast. And when paper meets physical, the truth gets expensive. Here's a wild example. In 2021, during the short-lived silver squeeze, bullion dealers globally sold out in hours. Premiums on coins hit 30%. The COMEX nearly ran dry. That event burned bright and fast, but it planted an idea. What happens if the next squeeze isn't emotional, but structural? That's the potential black swan. Not hype, just mechanism. A chain reaction between financial engineering and physical shortage. Now imagine this. Silver spikes 15% in a week, then 25%. Paper holders panic, algos go haywire, mining stocks explode. Then, before the herd even wakes up, it snaps back down. Because regulators step in, liquidity vanishes, and funds dump exposure to keep balance sheets safe.
That kind of volatility doesn't just rattle traders, it reshapes policy. And it could happen this week. The crazy part? Almost nobody's talking about it. The media's busy dissecting the Fed's tone. Retail investors are watching Bitcoin. Analysts are modeling soft landings. Meanwhile, quietly, something fundamental is breaking in silver's math. If all claims were called at once, if everyone demanded metal tomorrow, the system wouldn't have enough silver to fill even 1% of contracts. Let that sink in. 1%. That's not a market, that's a mirage. And when mirages fade, the landscape underneath often isn't pretty. But it's not all doom. For those who understand what's actually happening, this is opportunity and warning. Because silver doesn't just move money, it measures trust. When trust in paper fades, real assets suddenly look alive again. It's what happened in the 1970s. It's what almost happened in 2008. And it's what may be starting all over again right now. But hold on, before we go deeper, let me ask you something. If this mechanism really collapses and silver finally re-rates to what the physical market says it's worth, who wins? Who loses? Drop your thoughts below. I actually read through the comments because half the insight on this topic doesn't come from analysts. It comes from people watching these cracks form in real time. And if you're the kind of person who likes seeing markets explained before the headline hits, keep an eye here. You'll see stories others miss long before they break the surface. All right, back to the story. The black swan isn't the price spike, it's the timing. All it takes is one outlier event, a delivery failure, a central bank policy misstep, a mine shutdown, to trip the wiring. And there are already 3 warning signals blinking red. First, liquidity spread widening in the futures market, meaning fewer players are willing to make tight bids. That's a sign of stress.
Second, record premiums between paper and physical silver in Asia. Third, hedge fund positioning, heavily short, assuming the price can't break higher. This is where irony enters. The more confident the system is that silver will stay quiet, the more violent it snaps back when proven wrong. And remember, silver's market is small. It doesn't take trillions to move it. Billions can. Even hundreds of millions at the right leverage point. That's why traders quietly call silver the grenade that fits in your pocket. You'd never notice until you pull the pin. Now, a lot of people argue, hey, silver's been stuck for decades. It's a relic. No black swans coming. But the same thing was said about oil in 1973, gold in 2005, and even US bonds in 2020, until they weren't. Markets don't break until everyone stops believing they can. And here's the strange detail. Central banks aren't hoarding silver, yet. They're hoarding gold. That's the next layer of irony.
By ignoring silver, they're unintentionally leaving it vulnerable to industrial tug-of-war, between nations building clean tech and investors searching for a hedge. So while everyone looks up, watch what's falling sideways. Because if silver rips past key resistance, say $30 per ounce, and holds, the psychology changes. Then comes retail. Then comes momentum. Then come panic shorts. That's when markets stop resembling math and start resembling theatre. And when that curtain lifts, the story won't be about silver anymore. It'll be about confidence, credibility, and the illusion of infinite paper. So, will this week break it? Maybe, maybe not. But I'll leave you with this thought. Every system built on leverage eventually tests the faith of those who believe it can't break. Silver's been testing that faith for decades, and sometimes the quietest markets hide the loudest endings. The question isn't if silver has a black swan moment. The question is, when? And who's ready when it does?